Everyone saw the panic. Most people missed what happened next. While retail traders scrambled to exit positions near $60,000, a different group quietly stepped in. The institutions did not hesitate. They accumulated. The question is not whether Bitcoin recovers. The question is whether you recognize the signal before it became obvious. This content is provided for informational purposes only and should not be considered financial advice. Market conditions can change over time. February 2026 opened with a bloodbath nobody anticipated. The first trading week delivered relentless selling pressure that caught even experienced traders off guard. According to reports, the asset touched $69,093 on February 9 after days of sustained downward momentum. The decline erased months of gains. As per market analysis, the pullback exceeded 40% from the October 2025 peak of $126,085. Every dollar gained since Trump's November 2024 election victory vanished. Elevated bond yields combined with uncertainty around Federal Reserve policy created a toxic environment for risk assets. Traditional markets offered no refuge. According to observers, the crypto sell-off mirrored equity weakness and a historic precious metals collapse. Silver posted its worst single-day performance since March 1980, plunging 30% on Friday. Bitcoin broke below $80,000 for the first time since April 2025. The correlation between digital assets and legacy finance had never been stronger. Liquidations accelerated the descent. More than $2 billion in leveraged positions got forcibly closed since Thursday. Both long and short traders faced margin calls as volatility spiked. The $80,000 support level that held for months crumbled within hours. The $70,000 psychological barrier became the new battleground. Market participants wondered if institutional buyers would appear or if capitulation would deepen. Thursday morning in America brought the initial shock. According to reports, price action pushed through $68,000 as global risk appetite evaporated. Within 24 hours, forced liquidations hit $1 billion. Bullish leverage bets accounted for $980 million of that total. February 5 delivered maximum fear. As per market observers, the intraday swing matched the FTX collapse for sheer violence. Price briefly crashed below $60,000 before snapping back above $70,000 in what traders described as the most dramatic reversal in years. The recovery surprised everyone. According to analysts, by February 9, Bitcoin had stabilized firmly above $71,000. Sentiment shifted rapidly from pure capitulation to cautious. Accumulation. Institutions viewed the sub-$70,000 zone as a second chance to build positions after missing the 2025 rally. Market structure began normalizing. As per sources, the asset reclaimed the $70,000 threshold on February 9, marking a decisive recovery from persistent selling pressure. The speed of the bounce indicated strong underlying demand at lower price levels. Bulls defended key support. Bears lost conviction. The tide turned faster than anyone predicted. Forced liquidation data painted a vivid picture of the chaos. According to on-chain metrics, combined Bitcoin and Ethereum liquidations reached $704 million in just 24 hours. Derivatives markets imploded as leverage unwound violently. Prediction markets reflected uncertainty. Poly market showed 56% probability of Bitcoin revisiting $70,000 or lower before month end. The odds of reaching $85,000 dropped to 41%. As per market data, the $75,000 level carried the highest implied probability at 54% for end of February positioning. Meanwhile, downside scenarios towards $60,000 held 42% probability. Exchange-traded fund flows told a different story. According to institutional trackers, January 2026 witnessed approximately $1.2 billion in net ETF inflows month to date. One mid-January week alone captured $1.42 billion in fresh institutional allocations. Individual sessions saw inflows exceeding $800 million. Total U.S. spot Bitcoin ETF assets climbed to roughly $124 billion. Early February brought mixed signals. As reported by sources, February 2 saw $562 million in combined ETF subscriptions. Fidelity's FBTC captured $153 million. BlackRock's product absorbed $142 million. No major fund recorded outflows. Institutions bought the dip while retail panicked. The recovery mechanics revealed institutional conviction. According to market analysts, the rapid bounce from $60,000 to $70,000 demonstrated powerful buy-the-dip sentiment among institutional cohorts. The successful defense of the $60,000 floor established a crucial technical benchmark for the remainder of 2026. Historical support levels mattered. As reported by technical experts, the $60,000 region aligned with the 200-week moving average, a long-term support metric that historically attracts significant buying interest during corrections. Derivatives deleveraging created opportunity. According to reports, the reduction in forced position closures allowed spot market demand to regain control of price discovery. During the initial crash, cascading liquidations amplified volatility and overwhelmed organic buying. As liquidation subsided, genuine accumulation could assert itself. ETF stability signaled confidence. Analysts noted that when exchange-traded fund flows stabilize alongside declining derivatives volatility, short-term sentiment typically improves. The relationship between institutional ETF activity and spot price performance emerged as the most reliable indicator of sustainable trends. Challenges remained visible. According to observers, Bitcoin's hold above $70,000 represented tentative stabilization rather than definitive trend reversal. Markets continued digesting conflicting macroeconomic signals. Buyers and sellers achieved temporary equilibrium, but broader uncertainties persisted. Forward-looking indicators suggest continued volatility. According to prediction markets assign mid-90% probability to Bitcoin testing below $65,000 at some point. The chances of breaking $60,000 hover in the mid-80% range. Long-term projections remain wildly optimistic. As reported by forecasters, certain predictions target $850,000 by early 2036. Reaching that level would require approximately 1,060% appreciation from current prices near $73,200. Near-term targets vary widely. According to price models, early February forecasts suggested a recovery band between $72,000 and $82,000 by February 9, 2026. Extended projections pointed toward $100,000 to $105,000 by month end, contingent on reclaiming major moving averages. Critical levels define the immediate path. Resistance sits between $74,000 and $75,000. Daily closes above this zone would invalidate near-term bearish structures. Support holds at $67,000. Maintaining this level is essential for preserving bullish momentum. The $60,000 psychological floor represents the final defense. Breaking below triggers deeper corrective phases. Where do you see Bitcoin heading by the end of February? Will institutional buying power this recovery above $80,000, or will macro headwinds push price back towards support? Drop your price targets in the comments below. This week delivered a masterclass in market psychology. Panic drove price to $60,000. Institutional conviction brought it back above $70,000. The recovery demonstrates that smart money provides support when fear peaks. The next phase remains uncertain. Trade carefully and prioritize risk management above everything else.